Alright everyone, Cowboy Trades here, welcome back to the channel for another update on Bitcoin and the stock market. So, it's been a boring couple of weeks for Bitcoin, which is why you haven't heard from me in the past 5 days. More or less, we've been trading at the exact same price within this tight range, but I believe everything is about to change right now. We've just got some new economic data come in. This economic data absolutely has crushed the S&P 500. It is sending the DXY up. The VIX is up 16% today. Government bonds are hitting new all-time highs today, and the TIP ETF is getting absolutely crushed along with Bitcoin. So like I said, I think this is a pivotal moment in the markets. We've finally got something worth talking about. Let's dive right into the content. Now, before we talk about the new economic data which just came in for the month of June, I want to approach Bitcoin from a purely technical perspective because I know a lot of people have been waiting for my updated thoughts on Bitcoin. Like I said, there has been no update for the past 5 days or so because if we look at the chart, our last update was round about here. What did we do? We went sideways, we went down, then we went up, then we went down, then we went up. We've pretty much been the exact same price. And if I am making daily uploads, I always want the next video, the next day to provide some type of marginal benefit or value to you. And when we're the same price pretty much every single day, there's really no point in me making a video and wasting your time just to say we're the same price as yesterday, the technical analysis is the same. Like I said, we're back today because there's some new data coming in, and I think now is a pivotal moment. But for Bitcoin, let's talk about what's happening. Now, we originally had this bullish pennant slash asymmetrical triangle drawn a little bit differently, but we've redrawn it to encompass the data because obviously we've been breaking sideways for quite some time on Bitcoin. I think this chart right here pretty well characterizes what is happening. You can clearly see we've obviously had that big impulse to the upside. I've been saying on the channel how I already think we're very overextended, so I personally don't think this is going to be having a successful break to the upside. What I've been saying is I think this is an asymmetrical triangle, and I think it's more likely now, if we draw the updated price target of the asymmetrical triangle, that we're going to be moving down to about $28,500. In that regards, really nothing has changed. If we are looking at Bitcoin right now, you can see with the redrawn asymmetrical triangle, we are having a strong impulse to the downside of the pattern. But unfortunately, we can't be celebrating right now. We've had so many swing failure patterns in the past couple of weeks or so. If we look at these blue boxes here, which characterize the sideways trend, you can see we've had many swing failure patterns, swing failure pattern, swing failure pattern, swing failure, swing failure, swing failure. I really need to see a daily candle body close beneath 30,400 before, in my opinion, this price target at 28,500 is confirmed. I'd also then like to see further continuation beneath this blue box, and I'd also like to see a daily candle body close beneath 29,700. Until something like this happens, I really wouldn't discount the fact that this could be another swing failure pattern. We really need to see these daily candle body closes once again beneath 30,400 and beneath 29,700. So there we go, those are my updated thoughts on Bitcoin in the lower time frames. You know my price targets. I still think we're coming down to the asymmetrical triangle breakdown at 28,500, and I still do believe this is one massive BART pattern which is going to start moving down very quickly to the price target of the neckline at 26,300. What else has changed since my last video 5 days ago in the lower time frames? Well, really not too much. Retail wallets are still buying, a little bit of stagnation is happening, and in terms of the institutional wallets, smart money, they're still not inflowing into the markets. Everything is pretty sideways, just like the charts. So let's move on to some quick updates in the higher time frames before we talk about the new economic data which has come in. I just want to remind you, in terms of the total altcoin market cap, we're still beneath the bull market support bands, weekly EMA ribbons. If we do zoom into the price action, you can see this week, and as of today, because we are having a sharp projection, we are getting a bearish engulfing candle. This is pretty small still, but we are breaking beneath the 200-week moving average right now. Like I've been saying on the channel, I do think altcoins are in this critical moment where they are about to have a huge breakdown to the downside. In terms of the total cryptocurrency market cap, if we just get rid of some of these important indicators, you can still see, like I've been saying, I think we're forming that right shoulder for the total cryptocurrency market cap, and I think we're breaking down to the neckline of around about 997 billion in the immediate short term. If we come over to Bitcoin on the monthly time frame, you can actually see that we are forming this regular bearish divergence, and on the monthly you can see the stochastic RSI is all the way up at 92 right now. So in general, I do think, like I've been saying on the channel for the past few weeks or so, that we are stopping out in this rally round about this 31,000 mark. In terms of our most important Bitcoin chart, which we've been detailing on the channel, you can still see that we are stuck beneath this critical resistance at 31,130. Every single time we've tried to get above this, this, we've had an SFP pattern and we've been launched back down to the downside like we are seeing right now. So once again, I will reiterate my thoughts on this. If we don't manage to have a successful flip of around about 31,000, if we then don't manage to have a bullish breakout of this huge resistance at 32,500, then in my opinion, I still think this is a bear market rally, and I still think we're going to be coming back down to the price targets which I have been highlighting. Now let's tie everything together. We just talked about the Bitcoin analysis. I now want to move on to new economic data and talk about what is happening in the equity markets. So to do this, I'm going to wrap up on the Bitcoin analysis and tie in the Bitcoin analysis with the options market analysis, which we'll then dive into when we talk about the stock market. So first of all, very simply, if we're looking at the Bitcoin chart on the weekly time frame, we've been looking at the put to call oscillator. When this oscillator dips to the downside, you can see there's far more interest in the puts than there are in the calls for the options market. From a technical perspective, a high put to call ratio is definitely bearish, and you can see when we do come down on the put to call oscillator, when we do finally start rolling back to the upside and there are less interest in puts as the market starts to roll back down to the downside, this has historically marked some rather significant tops in Bitcoin. And as you can see, the put to call oscillator has bottomed out quite some time ago and it is rolling back up to the upside. So this is another reason why I think on the weekly time frame and on the monthly time frame, like we just discussed, that Bitcoin is getting ready to top out and roll back down to the downside. So there we go. Those are my updated thoughts on Bitcoin in the lower time frames, and just a quick reiteration of what I think is happening in the higher time frames. Let's now move on to the new economic data. So what happened? Well, today we just concluded the June job report, and the job report came in much stronger than expected. Non-farm payrolls rose by 497,000. These were estimated to be at 228,000. So this absolutely smashed expectations out of the water with a strong job market. And the US jobless claims rose by 248,000. These were estimated to be at 245,000. So basically, these are the main important ones. This concluded the June job report. This type of economic data is what the Fed is looking at to base their monetary policy on. The Fed is basically looking to raise the interest rates until the economy can't take it anymore. And because the job market is still strong, the housing market is still strong, like we'll talk about with some new economic data towards the end of today's video, this really just lets us know that the Fed can further increase their monetary policies. Since this economic data came in, the VIX is on a tear to the upside. At the start of the video, I said it's up 16%. It is now up 19%. The DXY did have a sharp move to the upside. Now it's currently just lollygagging a tiny bit. If we are looking at what's happening in the DXY, in our last video, we did talk about the potential likelihood of a breakout of a inverse head and shoulders. It now looks like we got rejected on the neckline. So while this inverse head and shoulders breakout is no longer valid, in my opinion, you can still see that we are grinding up and making higher highs and higher lows, at least in the lower time frames. If we do come over to the daily time frame, you can see we are really trying to push above this 0.5 Fibonacci on this fib channel parallelogram. So in my opinion, the DXY is looking very strong right now. Now we'll also have to see how this develops, but this could potentially be a very, very large macro head and shoulders pattern. Now, I'm not the biggest fan of how this one looks, so really we'll have to solidify a really strong right shoulder with a breakout of 104.3 for me to, continue talking about this one. This is just an idea. However, if we are actually drawing this in terms of the candle body closes, this inverse head and shoulders looks a lot more convincing than if we are drawing to the wicks. Additionally, following the economic data we had today, the US 2-year government bonds pushed up and made new all-time highs. Now, this is extremely bearish. Why is this bearish? Well, let me tell you. Why would you invest in the equity markets? Why would you invest in the cryptocurrency markets? Why would you invest in very risky sectors of the economy when you can get almost risk-free returns on US government bonds 5% per year? I still do believe that government bonds have further to break to the upside. I personally am going to be targeting this 1.618 extension up at 5.4%. Then I think it's possible that we come up to the 2 extension round about 5.725% for the US 2-year government bonds. 10-year government bonds have not quite made new all-time highs yet, but as we've been detailing on the channel, we have bullishly broken to the upside of this bull flag over on the 10-year government bonds, and I do personally think we are heading right up to the 1.236 extension, up at 12.5%. Following today's economic data as well, we have the iShares TIP ETF. Now, we've been waiting for this breakdown for absolutely ages, and as you can see, we finally broken to the downside of this bear flag. For those of you who are new, the iShares TIP ETF is really important because this is really a leading indicator for the rest of the markets. If we look at the iShares TIP ETF, you can see this made new bear market lows right here on the week commencing the 29th of August 2022. This broke down and made new bear market lows, and it broke down and made new bear market lows ahead of Bitcoin and the equity markets. You can actually see the S&P 500 rallied against this for about a week or so before it broke back down to the downside. You can see iShares TIP ETF made a new bear market low here, and it took approximately 42 days for the S&P 500 to follow and bottom just after the TIP ETF did. Now let's wrap up the video on a quick segment reviewing some new economic data. I've been looking at a few different charts over in Bloomberg Terminal in the past few days or so, looking for some new content to cover as the markets have been relatively sideways. Of course, as I came back today to record this video, of course, the cryptocurrency and equity markets had to break down to the downside as well, and probably make this video another long one. But nonetheless, if we do look at the data which I have plucked from Bloomberg, you can basically see the housing and real estate market is pretty much the only sector which is holding up the equity markets right now. If we look at the economic surprise monitor over on Bloomberg, you can see right now we've had a lot of bullish economic surprises, which is really why the equity markets are following. And this is very, very similar to what happened in 2008, 2009. And why I reference 2008 and 2009 is because if you go back to 2008 and 2009, we were pretty much in the same sector where housing and real estate was absolutely engulfing the rest of the other sectors, and this is what was holding up the equity markets at the time. We're seeing the same thing right now. If we're looking at the housing and real estate market, we're getting tons of bullish news from this sector. If we look at the housing and real estate breakdown over on Bloomberg, you can see pretty much everything is bullishly in the green. The rest of the other sectors, for example, if we're looking at the industrial sector, they're all pretty much to the downside. Factory orders are down, business inventories are flat, capacity utilization is bearish, industrial production month over month is down. The only thing that's up is construction spending month over month, and this can largely be attributed to the massive increase in the past few years or so we've seen in PPI. So once again, the main takeaway of this is, in my opinion, the only real reason why we're seeing the equity markets rally right now is, number one, we're seeing a bunch of AI stocks holding up the market. Number two, we're seeing CPI year over year come to the downside. And number three, one of the major ones which we don't talk about too much is the fact that housing and real estate markets are extremely overextended. I believe they're in massive bubble territory right now. And because of this, I do think we are in a very similar situation to 2008 and 2009. I also forgot there's one final thing that I do want to talk about, which is kind of in correlation to what we've just talked about over in the housing sector. If we're looking at private forecasts over on Bloomberg, you can see the probability of a recession according to private analysis is 65%. If we're looking at real GDP, it is predicted to come down from 2.1% in the previous year to 1.3% in this year, down to 0.7% in the next year. Now, why that's dangerous to see GDP down at 0.7% is because this is the 2024 forecast, down at this purple line down here, 0.7%. Now, despite whatever the US government says and rechanges definitions to, a recession is basically two successive data points beneath 0% real GDP growth. We saw this in 2009, we saw this in 2020, and once again, right now we're sitting at around about 7% for real GDP. I do believe these numbers are rather inflated, but if we are coming to the 2024 forecast, this is at 0.7%, dangerously close to 0%, which is why we're seeing recession probabilities round about 65% for the median estimates and 61.8% for mean estimates. One final piece of economic data which I will leave you with is what is happening right now with the US PMI index. This is the Purchasing Managers Index, and it shows economic trends in manufacturing and services sectors. Now, when the PMI is above 50, this shows economic expansion. When it's beneath 50, this shows economic contraction. And the US PMI index is definitely a very powerful indicator because this is a leading indicator for the rest of the markets. Typically, we see things like CPI and PMI lead the markets, then we see GDP trail behind, and then we see the housing sector trail behind GDP. And right now, we are seeing a large disconnect in the PMI and the nominal GDP. So once again, the reason why I'm pulling this up is because we just discussed about the probabilities of recession recession. We just talked about what would happen if we saw a massive contraction in nominal GDP, which could correlate to a recession. This is just one indicator, the PMI index, which could be suggesting that we could be about to see a large drop in nominal GDP, which could lead to that recession, which we have been forecasting on the channel for quite some time. So there we go, my friends. Those are my full thoughts on what's happening right now in the markets. Once again, for Bitcoin, I really need to see a daily close beneath 30,400. If we do see that today, that is extremely bearish, at which point I would love to see continuation beneath 29,770. Until something like this happens, we are more or less just trending sideways. But like I've been saying, with this new economic data, with what is happening right now, with this economic data which is absolutely, crushing multiple markets, sending the TIP ETF down almost to new bear market lows, pushing government bonds up to new all-time highs, sending the DXY up, sending the VIX up, and crushing Bitcoin. I think we are about to see a trend reversal. Once again, my price targets in the immediate short term are 28,500 before we come down to the BART price target at 26,200. So there we go for today, my friends. That's all I've got. Unfortunately, I am going to be traveling for the next few days up until Monday. I am going to be going for a grading in Kendo, the one final grading I've got before I go for my black belt in 3 months' time. So I'm going to be a little bit busy traveling for the next few days or so, etc. But I will be back on Monday, and regardless, if anything important develops in the charts, I will post it over on Twitter at 618_cowboy. So I just wanted to provide you with an extensive update before I do leave for a few days or so. Once again, that's all I've got for today. If you did enjoy the content, make sure to let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Follow me over on Twitter at 618_cowboy. It's been your boy Cowboy Trades. I'm out. Peace.